A hard break there. Hopefully you can see my screen now and hear my voice. How we doing? Okay. Okay, great. Thanks, Sam. All right. As I was saying, the euro has had 3 up days in a row. There it is right there on the chart. Hopefully you can see what's going on. Why is the euro going up? And is there a possibility that it could keep going up? Is it likely to continue? If we look over the past several months, it just looks like it's in a range. Maybe it's going to hit a top and turn back down. And while it might do that for the next few days, I would encourage you to keep your eye on this trend line or this trend line or both of them. Okay, what I would look for is to see the euro come up, hit a little resistance, break through, hit a little resistance on the next, and then maybe even some more resistance at this horizontal, but to make its way through all of these and continue higher over the course of the next month. Why would I say that? Why would I make that prediction? Well, let's look at what's going on in the U.S. stock market, on the S&P 500, and I'll show you why. Well, as you can see, both the euro and the U.S. stock market have the same kind of big up 3 days. The U.S. market's a little bigger on that first day, right? And it isn't so much the fact that there's 3 up days in a row. It's what days they are. This is the last day, last trading day in the second quarter of the year. These are the first 4 trading days in the third quarter. In the US market, the majority of the influence in prices is wielded by large funds, institutional investors, the big guys, right? They don't move around thousands or hundreds of thousands, not even millions. They move around billions, right? And so because they do, they have a lot more influence on where prices are going to go. So if you know what they're going to do, it helps you anticipate what could come in the weeks and months ahead. There's an academic paper that was written a few years ago, and if you go to ssrn.com and you search for this phrase, turn of month effect, you can read all about how it is that at the end, the last, this one right here, equity returns at the turn of month, and also this one, MOM/TOM, that's momentum and turn of month effect, detecting the impact of CTA trading. Both of these studies, and there might be more. That one, equity returns at turn of the month. Yeah, I think this one might be the one I'm thinking of, in fact. But there are multiple papers, as you can see, about this idea. And what the idea is that at the end of the month, institutionals will reposition their money and their strategies based on what they think is coming up. And it's particularly true at the end of a quarter. And so what happens is you watch for the last 3 days of the quarter's end, and the last 3 days here are this one, and that one, right? You watch those last 3 days, And you also watch the first 3 days of the next opening quarter and sort of take them together and think about them this way. If I'm an institutional fund and I've got a whole lot of money and I want to put that money in and let it ride on whatever positions I'm going to create for at least a year if I can. I mean, if the market's really bad, then maybe I'll, cut my trade short. But I want to hold on to my positions for more than a year. That's typical of institutional trading. And in order to do that, I have to sort of drop off certain positions and move them on in a timely fashion. And I also have to report. So if I'm a, mutual fund or a hedge fund or something, that has people giving me money to invest, I have to report that most likely on a quarterly basis. I have to report to the SEC on a quarterly basis too. And so, what is on my books at the beginning of each quarter is what's going to get published. Now, if I have a stock and it's a big loser and it's a stinker and I want to get rid of it, or if I have a really great gain that I think is done, I want to bank that, and then I want to get ready to open up a new position. And if I have the ability to do so at the end of the quarter, that's what I'm going to do. I'm going to peel off certain positions I don't like and put on new ones at the beginning of a quarter. That's typical behavior. If one hedge fund does it, it doesn't matter. But if a lot of hedge funds do it, that's billions of dollars moving around in the market, and it shows up on the charts. Now, is there any particular reason why they would do this at the beginning or end, rather, and beginning of a quarter? Sure, it's because of a thing called earnings season. Earnings season is when the largest companies, the S&P 500, the majority of them all report. Now, sure, companies are doing their earnings reporting all throughout the quarter, all throughout the year, but the bulk of them tend to happen starting at about 3 weeks after the quarter begins and then going for about a month after that. And so institutions, it takes them a while to build up a position. If they believe one of these stocks is going to have a really good report, much better than the market as a whole expects, they're going to go out there and they're going to try and build up a position in that stock. Well, again, if one hedge fund decides, oh, we like Micron, we're going to build up our position in Micron. Well, that's probably not going to show up very much. But if a lot of them say, we like the technology stocks, that's going to make the NASDAQ move up. We like industrial stocks, and we're going to buy a lot of them. We're going to spread our money out. And if a lot of them all do it together, it shows up in places like this. And so what we see here is there were 3 days where mild gains were happening. These institutions were kind of sneaking in. And then all of a sudden at the very end, there was a bunch of selling. But that selling didn't seem to continue on the next day. That's a big bearish engulfing candle. A lot of people know bearish engulfing candles, like that's where you have, a small up day bracketed by a big down day. A lot of people know that that forecasts bearish activity, selling activity, especially when you see it like this, where it runs up and hits resistance right at the place at a recent former high. And you have this down gap here. I mean, all of this together looks terribly bullish. But I looked at it, and I was writing the Investopedia Chart Advisor email, and I wrote in there, this could be a reason that it's not going to continue lower, and that it's at the end of the quarter. And sure enough, that turned out to be prescient, because the next day, instead of getting a follow-on, a bearish engulfing candle needs to have, in order for it to indicate that there is going to be this serious continuing downward move, you've got to have the next day after it kind of confirm. And it doesn't have to be a big down day. It just has to be a very clear down day, and it should close lower than what the bearish engulfing candle is. That didn't happen. We gapped up, we did go down, but we didn't stay there. And so that is a pattern failure. All right, so a lot of people know what a bullish engulfing is, and they know that that predicts downward moving. And among candle patterns, there's a website called the Pattern Site. The Pattern Site. And if you look up candlesticks here, this is written by an author by the name of Tom Bolkowski. Now, it's just his back testing. This is all based on. You shouldn't get caught up in thinking that, whoa, these are the statistics of the market. And he did some back testing in his own way years and years ago, and he's published everything based on that back testing. But if you come in here and you look at the bullish, bearish engulfing candlestick, he shows that the frequency rank is 11, so it's pretty frequent, and the overall performance rank is 91. That's, like how far does it go? But this is a really interesting statistic. Bearish reversal 79% of the time. Isn't that interesting? That's a high level of reliability, that this thing is going to predict that there will be a bearish reversal, a downturn, and 8 out of 10 times it's going to happen. Here's what a lot of people don't know. If in fact it doesn't work, if in fact that pattern fails, because this is a pattern failure as of the 1st of July, right? That there's like a better than 70% chance that prices will go and make a new high from there. Well, it did it in 2 days. That's what happened, right? So when I saw this fail, I wrote the next day, hey, that's a bullish indication. Now here we have these 3 bullish days. What's going on? It's not just a little bit of conviction. This is a lot of conviction. These institutional guys, they're really pretty certain that there's going to be good news coming up at the end of, or in the middle of and through earnings season. They can't. It's not that they could be expecting the Fed to raise rates or lower interest rates. It wouldn't be that, would it? Well, it might be a little bit of both, but it certainly is the case that they are expecting good earnings reports to come along. And because, in fact, we have the euro looking so similar, the euro-dollar pair looking so similar, you got a strong first day. This is these days are a little different. This Friday. Oh, right, because this includes the 4th of July. Yeah, so we got Wednesday, Thursday, and Friday here, these strong days. I mean, it's interesting, right? So this tells you that the US dollar is weakening just a little bit at the same time that the US stock market is riding higher. We should actually look here and show you the correlation. Rather, let's do it this way. Correlation coefficient between the US dollar, or the euro US dollar pair, and the S&P 500. To make this nice and clear, I'm just going to change a couple of things here. Area, and let's make this a quarterly length rather than a monthly length. All right. And if I back this up a little bit, here's what I want you to see. Starting in 2002, when the Fed began to raise interest rates, can you see how this correlation coefficient has spent most of its time on the upper half of that line? And this is not the way it's been in the past. You see, you get up, down, up, down, up, down. But here, since this time, it is strongly to the higher side. Why is that? Okay, well, what this is saying, this correlation coefficient is saying that the euro and the US stock market are highly positively correlated most of the time. A little dip here, September, a little dip there in June, and a little dip there last March. But other than that, highly correlated. And so this correlation is likely to continue ever since the Fed started increasing interest rates and has kept them up at that level. The dollar, the value of the dollar, has become much more connected to the US stock market because both stock market investors and currency investors are paying close attention to the interest rates on the US dollar. And so as long as these interest rates remain high, you can expect the euro and the US stock market to be tightly, positively correlated. So if it's happening in the US stock market, it's likely to keep happening in the euro. And thus, why I'm saying we could get a movement on the euro, which is continuing bullish, because I expect the large institutional investors to come in there and put more money to it. And if in fact there's good news, more money still, and the retail investors will follow along behind, and so forth. So all of that is going to create a bullish movement in the US stock market, and that should translate into a more positive and bullish movement in the euro. So much so that we will probably break these longer term trend lines that the euro is on. Now, if the euro is going up because the dollar is weakening, now let me explain that connection real quick. Why would the dollar be weakening if the interest rates aren't dropping? Well, it could be that investors are expecting them to drop in the next few months, or it could be this. If I am a US investor and I have $1 million in my bank account, my retirement account, and I want to put it to work because I see the market running up, and I need to be invested. Inflation is high. I need my investments to be higher. Where can I get good investments? Not in real estate right now. And commodities, that's a mixed bag. But stocks are going up all through 2023 and first half of 2024. We've had a nice strong bull market. Why wouldn't I think that that's going to continue, right? So I want to move my money out of cash and into stocks. And that's a big influence of what's happening. So people are moving money out of cash away from the US dollar, and they're using it to buy stocks, at large institutional investors especially. They are reducing their cash positions and increasing their stock positions. That's why the US market drives the dollar lower, even if the interest rates are holding high. Okay. And so if that's happening, the dollar's going down. Well, the euro is a 60% teeter-totter from the dollar, so the euro is going to go up. And that's what maintains a correlation between the US, the euro, and the US stock market. So it's really worthwhile to watch the stock market for clues about what's going to happen with the euro. And it's never been more true than the past year and a half. And as long as conditions don't change with interest rates, it's likely to remain that way. That hasn't translated into a strong bullish market for the euro, though, which has been kind of interesting. But it's very possible that we could get that now. You look at, let me change this, take the correlation coefficient away, and add just a simple rate of change. And any old oscillator will probably show it to you. as you see this thing start to come down, we got a low here, and then we got another price low right there. Um, and then let's see, settings. What are we? Oh, we're only at 9. Sorry, this is going to be a little longer. Let's go out to say 30. 30-day rate of change there. That's a little better. Um, yeah, you see how that, there it is right there. So it's hard to see. Maybe if I make it a little more pronounced. This low point on February 6th is connected to this low point right here. And shortly thereafter, we get a lower point on the euro, and the rate of change is going higher. And this is what we call a bullish divergence. And that does make a short-term upward move. But then you get this thing here, which that low point comes down to this level, and the rate of change here did not come down to that same level, even though the euro makes a lower low on this trend. And so what we're seeing there is a bullish divergence. You've probably heard that term before. This thing is going up while that thing is going down. That tends to mean bullish, changing from bearish to bullish. And here we haven't fully done it yet, but we're going down, down, down. And now, is it possible that we will start going up? We've got the higher low. Now we've got to put in the higher high, which would mean breaking through all three of those lines of resistance. I think there's going to be some chop for the euro over the next 2 or 3 weeks. But if we do manage to see the euro manage to break through that top line and close above it, I think it's kind of blue sky from there for the euro. If in fact the euro does that, well, that tells you a lot about several other pairs, because the US dollar is on the other side of them, right? We would expect to see the Aussie dollar. And sure enough, the Aussie dollar has already broken out of that little resistance level. Could it be on its way? I mean, we probably won't go straight up, but could it come up here and best that high? Yes, it certainly could. How about the Canadian dollar? Well, that one's a little more tricky because it's so tightly connected to the U.S. economy. But sure enough, you've got this downward line that has already broken through, right? And so you're seeing this on the U.S. dollar pairs, U.S. dollar weakness, and the other pair, whatever it is, showing a little bit of strength. And so it's a consistent thing, which I would expect is going to hang around. Now, US dollar in the front position of the dollar yen, what are we thinking here? Is this going to keep going higher? Well, it shouldn't. And in fact, look at let me reset that chart. Look at what we're seeing here on this momentum, the rate of change. We see this making a higher high, but this making a lower high. See that? That is a bearish divergence, and also very consistent with everything I've been saying. Now, the yen has its own issues. The Bank of Japan has its own issues and problems. And so this chart might not work out exactly like the others. But generally speaking, I would expect that could be a major turning point, that you could see the dollar weaken against the yen in the days to come. Just a possibility. But that's the reason for it. We're at the beginning of a new quarter. U.S. and institutional investors are expecting good earnings. Something that would change all of this is if somehow earnings came through very poorly and the large companies were reporting bad results with their earnings. There'll be a few that will show bad results that aren't connected with everybody else. But watch Microsoft, watch Apple, Google, Amazon, watch those four most closely, and you know, Meta and Netflix and Tesla and Nvidia, you know, all of those. And Nvidia, I think we're going to have to watch closely too, because Nvidia's you know, its market cap is so high, it has become unusually influential on the market. And Nvidia's earnings are way out on the end, so it's going to take a while before Nvidia shows its influence here. But the earlier ones are going to be Apple and Microsoft. So on Apple, in the case of Apple, we're looking at just about 3 weeks away. It is Wednesday, July 24th, when Apple will show up. See, now this whole thing with Apple just running up higher and higher and higher like that. This is the moment when Apple says, "Yeah, we're getting into AI," and so they're going to become a AI company. I mean, at least from an investor standpoint. And nobody thought they were up until this moment. Now all of a sudden, boom, up they go because of this partnership they're going to do with OpenAI. That's a lot of hype. That is a lot of hype. They haven't, you know, started yielding products and stuff yet. You got people running in. You got analysts pushing this all the way up to $260 as a price target. So there's real possibilities that this earnings could shock people back into reality, and you could see Apple fall. If that doesn't happen, because this is going to keep going, Apple's going to keep going for the next couple of weeks, I would expect. If that doesn't happen, then I think you see Apple start to play catch up on Nvidia. And so, and of course, if Apple goes up while Nvidia is continuing to go up, then you'd have this huge influence on the market. And so we could end up seeing a really great quarter ahead of us. Microsoft is quietly just charging forward. Their earnings day is on the 23rd of July. So here in, you know, a couple of weeks, well, just under 3 weeks, we're going to start seeing some very interesting data come through, and investors are going to pay extremely close attention, pour through all the details of Apple and Microsoft and Google and Amazon and so forth. And things could change if all four of them turned in a very disappointing report. Then yeah, things could change, and the market could make some sort of turn. But I don't expect that anything will change between now and then. The trajectory is up, and that will reflect, as I mentioned before, on the euro and other dollar-related pairs. So I think this time for the euro, there's going to be significant momentum to try to push it forward. And that is your weekly market update. I hope that's useful to you. Until next time, take care, trade well.